In today's video, we need to discuss everything going on right now in markets. Volatility is spiking across the board, and a lot of it has to do with Meta, a new dividend being announced, and of course, a huge aftermarket move of over 14%. Amazon's big earnings show growth and stock is surging after hours, but at the same time, one of the biggest stocks in the world had a China shortfall, falling in aftermarkets trade close to a new low. So with everything going on right now, are we still in a buy the rumor, sell the fact style market with tech earnings kicking off a potential problem along with FOMC? Today, we'll take a look at the seasonality and the hidden divergences that are going on within the market. We're probably going to get a gap fill on the S&P, and at the same time, we've seen regional banks coming into some worries with a big sell over the last two sessions. But what might be more surprising is this chart. So join us right now as we dissect the hidden divergences going on in this market right now. Well, welcome back everybody to the Daily Show, where we talk about stocks, commodities, and cryptos together, including the macro lead indicators and of course the hottest charts. There's a lot to discuss, but it was green across the board with banks and energy actually down through the session and a couple of semis starting to struggle. Meanwhile, big bumper earnings after hours took us higher than we thought we would go, and we broke through some of the big key points that you would usually see the S&P 500 find some bear action. What was doing well? Well, it turns out the gold was actually the best return on the session with huge moves across so many gold fiat currency pairs, and regional banks were down 3.12%, sliding again from the previous session, taking us to a 5-day return of negative 7.3% for regional banks. Is there something more sinister there? Well, it looks like defensives have really been coming through, and this has got, I think, a lot of people worried that have been following the market for a long time. Staples just had its best year in over, or its best return in over 1 year. And utilities and healthcare have now got the best 5-day track record. So yes, we rallied and it looks like we're going to come through pretty strong, but there's a lot to discuss. Just a quick reminder, we're bringing back our weekly newsletter, which had such a great result last year. So if you're interested, sign up in the links down below, and it's really easy to do so. So let's take a look through some stats here. First up, we've got the VIX. How does the VIX usually act on Friday? Well, funnily enough, it's actually usually a down day for the VIX across 2014 all the way to 2024. Interesting that we often see a lot of VIX spiking throughout the Monday sessions. Now let's take a look at gold versus other major currencies. We posted this over on our X account if you want to follow, links in the description down below. And you can see here that gold is making all-time highs against so many currencies. Of course, it did have a bit of a breakout in the last 24 hours versus the US dollar, but we've had massive moves across almost all the other major fiats in the world. Now we go over to an indicator we haven't brought up in a while, but I do love it very much. And that's, of course, bullish percent index. And you can see here that we've got a shifting of events after we hit the 80 level. Usually that's considered overbought, and the market has since been going down. Now I checked over the last 24 hours, and similar to a bonds indicator we'll look at later in today's video, we're still seeing declines in these indicators even though the market has been rallying up. It's not the type of thing that you generally want to be seeing, especially at a topping or potential topping of this market right now at a period in time that makes some sense. Returns after the Q's decline after an FOMC day. We've already talked about this one, but there's some interesting stats here. It shows that there's going to be, I think, a bit of volatility over the next 2 weeks. And while it looks like everyone's on the Meta Amazon high, we do need to remember that it's really two stocks that took us up there. And it was an absolute ballistic report from Meta. I mean, plus, I think it was like 15% at one point is a huge deal and possibly an overreaction from the market. What do you think? In the links in the description down below, though, let us know if you think it's an overreaction. Obviously, we're sitting at around plus 20% in terms of the 6-month move. That was very similar to what happened last time. And this is just a very important point for markets. We're close to that 5,000. And just remember, if you are trying to stop a freight train, you're trying to go against the market right now, it is very hard to do so with futures and CFD action. It's generally going to be better, and we always talk about it from the option side, and that's because, of course, puts are relatively cheap right now. Some surprising things or good things about the market and why investors, I don't think, need to worry too much right now is that we still do have a huge amount of monthly excess savings. Obviously, the total excess savings is declining, but it is suspected that it may support the American consumer throughout 2024. But we've got more on the American consumer and the hidden movements underneath coming up soon. Today's video, which I think really will blow your mind. It's not really what we want to be seeing in terms of this market. We've also got the put protection being very, very cheap right now. This was taken from Goldman Sachs a few days ago, but as we know, it's been relatively cheap to hedge portfolios at this 4,900 to 5,000 zone. CTAs, what are they doing? This can be also another one of those kind of signals that we're putting together, and we are starting to stack some signals around these zones. And you can see here that we have CTAs super overbought. Now, we did see a small movement towards the downside. Do remember, it's the daily 20 moving average that often does trigger CTAs to really reduce their position. And we've still been holding above that. And while we expected 48.50-ish zone to hold the market throughout the last rally, and of course move up to 48.90, it was really the after hours that pushed it through. That huge meta result and Amazon just absolutely sending the S&P 500 right back up. A positive January is the good thing for the rest of the year. The answer is yes, it is. And of course, the stats don't lie in terms of how well it generally does. What about February though? Well, if we tend to sell, it usually begins somewhere in the middle of February. Now, we're just early on in the February period. Of course, it could come earlier, but don't be surprised if the market has to do a whole bunch of shenanigans before it chooses to fall through. Remember the 48.50 zone or 48.46 area that we've just bounced off. That is now a major swing point for these markets in terms of where the bears sit. The S&P 500 election years, this is how they generally move. You can see that we usually have a little bit of a topping early on in Feb during, let's say, sitting president running periods, which it could be. And of course, we may be moving into that first quarter weakness. Now, we've talked a little bit about first quarter weakness for a while. We've obviously discussed April being the most important month of the year for the rest of the months. And more importantly, the middle of the year being an exciting time for the bulls, potentially seeing a further extension on this market. Why could that be? Well, of course, Wayne has done some amazing information here to do with the November to January middle run. And he's found that in similar circumstances, and we do have a good cross section here, we have a 35 to 2 losses, with the losses being relatively small in comparison to some of the massive gains that we've been seeing. An average change of 16.5%. So again, a longer term bull is going to be sitting there saying, yes, how good is this? But somebody that is looking for a bit of action obviously is still looking at this first quarter. Why did the markets rally? Well, a lot of it has to do with where we saw the puts, and we had a lot of puts rolling through at 48.50 on the 0 DTE. We obviously saw 4900, which to me, like a 48.90 was one of my expected resistance zones for the S&P 500. We'll go through that later. And it closed right around that kind of level. Then came the earnings, which pushed us up to, lo and behold, 49.25 zone, a gap fill, and also where we tend to see a bunch of calls. So of course, we expect that potentially to be where the sellers actually sit in the markets, although this is a fairly ballistic market. So it may take a new high and it might even turn into some kind of Wyckoff distribution. I do think it'll be pretty hard for this market to get through 5K clean though moving forward. Talking about China, WorldCom obviously filing for bankruptcy back in the day. That's similar to what we saw with Evergrande this week. And we know that the stats, I might have just blinded everybody there. We know that the stats overall have that the Hang Seng here is generally going to see some type of real issues over the next 2 weeks. This was taken about almost 2 weeks ago now, actually. And then we tend to see a bit of recovery through the next couple of months. This is still the stat that seems to play out. And obviously we expect China to come in with a whole bunch of support. Is the economy, I've seen a lot of comments, is the economy in trouble? Absolutely. Are they in certain issues? Absolutely. Is it really bad? Yes. But at the same time, most of the stocks are between 75 and 90% down. So it's not like they haven't already been sold pretty heavily. Let's talk Tesla. Tesla has to bounce and it's losing days very quickly here. Why? Because it just made a 6-month low and obviously it gapped down over 5%. We've only got a few reads from this, but still quite a lot in terms of 5 overall reads. An average return of 18% with 100% win rate in terms of elastic movements towards Tesla's buy the dip. If it doesn't see buy the dip, you might be starting to see a waning market for Tesla. That is, people are starting to get a little bit less interested in the stock. All these things could be worrisome for the longer term investor, something to be looking at. Apple, Amazon, and Meta, they're now done, and they were huge. Now, we still have Exxon. We've got Chevron as well over the next 24 hours coming out. That's sure to move gold. Sure to move black gold, as in oil stocks. But you can see here that Meta was expected to move plus minus 7. So yes, it was going to be the most volatile according to the options market, but it moved 14. That's a huge move. By anyone's circumstance, that is a massive move. And Apple moved pretty much as expected, plus minus 3 and a bit. So Amazon, everything else, maybe it was in line, but Meta certainly brought the big guns in terms of sending this market back up. And was it really a fair move? 50 cents, 14% move. Wow. I think it could be an overreaction here, and we might see some nice blow off on that one soon. Let's go through here what's going on with the markets. So we can see that we have quite a lot of unexpectedly large big options moves. In particular, we're starting to see a lot of action on TLT. We've been bullish on that, of course, this week in general, and it's sitting at 98.24. I do think a 110 could be on the cards this year for Treasuries, so it's a pretty interesting level. A lot of big options going through on what you'd expect, which is after announcements, such as things like Google and stuff, getting a lot of calls, and it didn't really move that much. Alphabet only up plus 8, sitting at 141, obviously 140 being near its low. 41.7 million in terms of options volume compared to a 40.1 overall options volume, and you can see 55% calls versus 45% puts. So still a huge amount of options movement, and no doubt quite a lot of hedging going on each way. Let's talk about S&P 500 versus the central banks around the world. They're still flatlining, so we're not getting much information here, but I do like to bring it up daily. If there's any changes, we'll alert you to it. The volatility of the volatility, the VVIX, which seems to be what we have to use nowadays, or the VIX 1D, you can see that it's still relatively high. VIX itself has dropped right back off, back into the 13s. But still, the volatility is high because we've got non-farm payrolls in less than 24 hours. Yields have come down all the way into the support. So look at that. We've got this whole call from Jerome Powell saying, yeah, we're not going to do rate cuts anytime soon. And the US 10-year is dropping like a brick. So this thing is absolutely falling off, and that's helping gold. As we've talked about before, that's a big deal. And it's also really killing oil as well, which is pretty common if you see the US 10-year go down. Look at the 2-year, also about to make potentially a new low. So what happens here with non-farm payrolls could be very important. Watch the yields, and in particular, watch the dollar, as the dollar is going to move a lot. We can see here treasuries have had a massive gap up style move, huge volumes coming in, and a lot of people hedging on this. And I think it's a good point for us to go through this chart. Now, this chart is super interesting. Basically, this one at the top here is the S&P 500. Then we've got here basically treasury yield versus high yield in terms of high yield, and what we generally expect. So we'll get rid of the S&P for a second. And what we're generally not looking for is we don't want this chart to be spiking up if you're a bull. Now, when you've seen this spike before, it often does end up leading into the markets actually falling off. And you can see here down below, we've got staples as well that we've overlaid against a few things. So basically what we have here is we have a market, and we'll go down to the daily just so we can see it, that's starting to show defensive movements. We've got overall IEI moving up against high yield bonds, which basically is telling us that the market is moving defensive. This is absolutely what's happening underneath the hood right now. And we've also got defensive movements here on staples in terms of the breakout. So we have a breakout in defensive staples. We have the best day in 1 year for defensive staples. We also have a huge movement here against basically anything that's risky. So you can see defensive positions starting to come through. And it does have to make us start to question what's going on underneath the hood. We know we've talked a little bit about the American consumer before, but have a look at our bond indicator as well. Our bond indicator had another negative session on it. And this is not what you want to be seeing when you're talking about a market making a new high or anything like that. These are not good issues. And of course, we could still drive a little bit higher, but it's not the type of thing we want to be seeing. Home builders here, you can see that overall that's still chunking along, actually moving higher, 2.53% up. Pretty good session for it. We've talked about this being a possible distribution for a while. Obviously, we haven't set an alert anything that's broken yet. We've been trading in between, but it's still one we're watching along with transportation. But I want to talk to you about the American consumer. This is a chart we've brought up many times before, and it's showing us here very worrying sign. Basically, this is consumer discretionary versus staples. it's been moving lower now. And I'll show you, since it's been moving lower now for a while, 18th of December. And I never used it as an initial, because if you've been shorting the market since the 18th of December, that wouldn't have really worked out too well for you, although it hasn't moved that much really, unless it's tech. So you can see here that we've come down. Now, this is starting to get a bit worrisome, because you might notice that this was an indicator that also moved in November of 21 towards the downside, and often moved just before the rest of the market. I call it a precursor of the market, and it shows you a defensive nature of the market, which means that someone, not us, but big money, somebody, some type of big money, whether they're right or wrong, is moving to the defensive side. And they're doing that across a whole bunch of different instruments. We're seeing gold moving. We're obviously seeing defensive moves across the board, and we're seeing people getting out of junk and going into, let's call it, a more stable crediting system. So that's got us worried a little bit here on the markets, because when we make a new low and the rest of the market's making a new high, it's showing you the American consumer's not coming along for the ride. And we've already talked about delinquencies going up and all these things. They're starting to stack into a period that you would usually see it stack in. And, you know, you can take it with a grain of salt. But of course, if you see the price action come with you in this case, you know, you have to practice, of course, caution and everything like that. But if price action does end up triggering, especially under 48.50, it's a very interesting point. We've also seen semis go down, which we've talked about before. Let's discuss copper right now. So, of course, copper breaking to this high point, going to 3.95 and then rejecting back down. No movements on the copper bandwagon yet. Of course, 3.95 plus would be a strong move here for it. And oftentimes, if copper does end up falling through and going down, that's not usually a strong thing for the economy. So that's something that's interesting to be watching there. What about the US dollar? Well, it didn't quite get to what I wanted, which is, of course, 103.80 to 104. And I've kind of talked about this a lot, like a parrot. And it's been sitting here, and that's not exactly the best candle I've ever seen. Now, we find ourselves almost in the middle of two zones before non-farm payrolls, a potential defensive buy, and of course, a potential sell that comes up here. Now, these two levels are something I'd like to see a spike come in through the non-farm payrolls. Just remember, with non-farms, it often goes off in one direction and then reverses, and that's because it often gets liquidity grabs. We've seen this many times before. If anyone wants to chime in with the comments down below, if you've watched enough non-farms like I have, and you've seen that happen, let other people know so they can see it in the comments. But that's something I'm looking for in the dollar index. And I guess, look, we're still going towards the overall movement. We'd like to see a 103.80, 104. But if this weekend's negative, it's not going to be so good. You can see here we've got a doji. Will we get a decision made and continue on with the trend down for dollar index? If that happens, you're going to be seeing yields making new lows. And of course, you're probably going to be seeing gold break through this key zone. So 2055, 2060 hit over the last 24 hours. It was showing some signs of weakness, strength. I actually thought in the last video we were probably looking at about 55% strength. I have preferred GDX, which is obviously the stock itself, and it had the best session. So GDX did hold up. That was actually not too bad. So you can place defensive trades even though the market's gone back up. You can see here GDX breaking through the 20 moving average, which is pretty good. And it's starting to signal that maybe gold's on its run. It's running against almost every other fiat currency out there. Maybe we're about to see and witness gold break out to a new high in terms of closure points and really get significant. Obviously, a breach past 2078, 2080 is going to be a big deal for this shiny metal. Oil didn't fare so well. We were, of course, cautioning onto the sell side here from that 78 level. Of course, if it ever breaches 79, I think it's going 82, 84 a barrel. But we did start to see weakness, as we spoke about in the last video, based on our day trading masterclass. Links in the description if you're interested. And of course, the market ended up weakening off. This is a good, well, it was already at a good break-even zone, but this is a good TP number 1 or 2 zone. If you took some profit off here, nice. This would be probably where I would start to reduce fairly heavily. And the reason is going to be quite simple. We're starting to get into that heavy structure where you've seen previous buys. I would say still it's looking towards the negative side in terms of oil, but really comes down to yields. If yields break to a new low, expect oil to get thrashed at the same time. So 78 might be all we got on that one. Let's move over to Apple. After market, we get 180, which hits us right into here. Now we know that the most accumulated position sits at around 178, almost 179. So around this level could be where we see a buyer try to come back into Apple. It has been weak. Obviously, we talked about this rejection week. We thought that we might get this as a result, and this one was probably no surprise. We probably expected the market to not like the Apple result too much, and that's because they've been angling for it for a while. But where the surprises were had to be in Meta, and I'll actually load Meta up here. This thing was flying after hours. I think it was at 450 or something. So this was, I wouldn't have expected it. 450, no way I'd expect that kind of move from Meta. It's been very strong. It's been certainly on the buy the rumor, and I guess it was buy the fact at this stage. I'm going to be watching this one very closely. If it comes out in the morning and just gets thrashed back down, so sells heavily, that's actually a big warning sign. So we'll be looking very closely at how Meta trades. That's going to be a big one. We also know that semiconductors are still not great. So they're, of course, showing the island reversal still totally in play. And that's one of the strongest sectors in the market. So if it keeps weakening and doesn't actually rally too much in the next 24 hours, that could be a problem. Tesla, still in the range, guys. Nothing changed. Watch reaction, previous accumulation zone. I'd like it to sit here for maybe a week or so, build a nice base, then give us a clear direction for the next move. Let's now talk everything else about markets. So we'll go over here to the Chinese market. We're talking K-Web here. Is it the low? Well, we don't have any change, but obviously we're still looking at these stats. Another one to watch, which is the one we brought you the stats from, which was HSI. That's kind of floated around. Now, that's actually found what I would call a turning point. So to me, this is actually looking a little bit bullish. And it's the first sign of a turn in what's been an absolute cataclysmic decline. And this is actually trading, if you can believe it, all the way back to a price, imagine this, of 1997. Imagine investing in 1997. Look at me, I've bought the best market in the world, and then you're sitting here in 2024 at the exact same price. Yes, okay, it went higher at one point, but that would be kind of depressing as a longer term investor. Instrument selection is very, very important. US 2K, now it came off a level that we had a little box for, sure, but this is a zone where you would be seeing a potential bear. Oh, it's a tough market, this one. I can see why you'd buy here. I could also see why you'd sell here. It's one of those ones where I'd almost be playing a 50-50 game with it and hedge both ends. And that's kind of the way I'd feel about this market at this stage. So it's certainly a very important one. What about the Qs? Still showing, obviously, an island reversal here. After market, you're looking at about 425 in terms of where the Qs were. So that's going to be an interesting zone for it, 425. Getting almost into that gap fill, which is pretty much right there. And then we'll see whether the bears sell it directly into the day. Again, Meta being a huge one of those moves. Now we move over to the NASDAQ. So my theory was that we could move back to here and see sellers. We saw nothing. I mean, nothing. Look, the thing just crunched that level and just absolutely ate it alive. So this is where I thought it would be. Nothing's happened yet. To stop a freight train is often quite hard. Sometimes it needs a new high, etc. But as I've mentioned, it's not really the NASDAQ, it's the S&P that I want to focus on. So the reason I want to focus on this is because we know that this is a big demand level. We thought that this would come up to here, being the 48.90 zone. And this is where I thought we'd see some sellers come in. And let's have a look at the small time frames just so you can kind of see how it floated around. Now, you can see a reaction off this level. So obviously this is a supply, we all know that. And the market did react to it, but then came the after hours and just this huge flush. So it ended up moving up here to trade at 49.34. And this takes us back into filling that gap, which is obviously at 49.24. And then we'll find out how it wants to trade. At the moment, we have a high, we have a higher high. We might get a higher high. If we do, and then we sell off and we get underneath here, that's when a swing trader is going to be very, very active on the short end. And obviously, I'd expect CTAs to be involved. For bulls, you guys are probably pretty happy with this. You're just going, you know what, just give me a new high. I don't care. 49.50, 5K, man. We're going to get to those levels. Obviously, still huge gamma levels. So those points are going to be a big point for the markets. And look, the trend is still intact. I mean, we didn't manage to get past this level. We did close on the low, which usually means to me that there's a seller somewhere around. But I think the defensive nature of the markets is one of the most worrying signs right now. Let's move over to Bitcoin. Bitcoin's still finding a little bit of weakness around this supply area. You can see here that we got a change of trend that's in here. We saw some selling that came through. We obviously have no swing turn, so we're still bullish overall. But if you're going to be short, this is usually the area where you expect the shorters to come in. Bitcoin, interesting one to watch over the next 24 hours. We obviously will be. So non-farm payrolls, it comes in. This is the jobs number, arguably one of the biggest news events of the month. We're expecting unemployment rate to 3.8. We're expecting non-farm employment change 187, according to the market. And it often goes opposite direction and then another one. If you enjoyed today's video, please remember to subscribe and of course smash that bell icon so you get the videos daily. And do remember, we've got our free VIP weekly newsletter coming in next week. So make sure to sub for that. There's a whole bunch of macro I'll be putting into the newsletter so you guys can see it. It's an interesting time, guys. It's very hard to dissect, but there are more signs here than we've ever seen really over the last 4 months in terms of problems in the market, specifically the defensive moves. Unusual to say the least. Bye for now.